Okay, I would like to call to order the Kentucky Retirement Systems Investment Committee meeting. Today's February 21st, 2024, and it's approximately 10 a.m. Do we have an opening statement?
Yes, ma'am. For the record, I want to note that this is a meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statutes Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Can we have a roll call?
Yes, ma'am. Mr. Lane. Mr. Atkins.
Here.
Ms. Bova.
Here.
And Ms. Thompson. Thank you.
And do we have any public comment?
No, ma'am, no public comment.
Thank you. And okay, so remind me that we don't have a quorum, so we're going to postpone the motion to approve the minutes until the next meeting.
Yes, ma'am. That's
Okay.
Without a quorum, we'll just move that to the next meeting.
Okay. So we'll just go straight into Steve. Do you want to tell us
Sure.
about your stuff?
Sure. We'll hit very quickly here. Page 9, please, Sherry. Investment budgets. Just highlight that through the first 6 months of the fiscal year, actual expenses are running well below the amounts budgeted for the full fiscal year, with approximately 75% of the amount budgeted for the year remaining. That's really been driven by our legal and auditing expenses, and specifically the legal expenses. Year to date, that's the most significant divergence from what we had budgeted. We do anticipate that in the second half of the fiscal year, those expenses will ramp up pretty significantly as activity picks up on some cases and litigation. So we would expect that to move significantly in the second half of the year. Everything else, all of our contracted services are running kind of at budget level. I would highlight the one that stands out to me is the BNY custody fees. We've only paid 1 quarter of fees so far. They're behind on their invoicing, so we're trying to catch up, and we anticipate catching up this quarter. So as of the end of the third quarter, we should pay 3 quarterly invoices. It'll look more in line with what we had budgeted.
Steve, do you know if that's also the case with legal expenses? I know sometimes they go months without billing it, so then all of a sudden we'll get a big bill.
It's a little outside of my depth, but yes, my understanding is those do tend to get paid pretty promptly, or invoiced pretty promptly and paid promptly by staff. I think it has more to do with the activity level of the legal cases, the ongoing cases. And speaking with Michael and Vicky, I think the expectation is the next 6 months or 4 months, I guess now, activity is going to pick up on a number of cases pretty significantly. So we'll see those expenses rise pretty rapidly. That one's always hard. I worked a lot with Michael when we set that budget as to, that's a tough one. Obviously, it's contracted at a rate, but the activity, the number of hours billed varies pretty significantly. The only other thing that Michael had highlighted is, we're at the point where the insurance that was paying for some of those expenses has been exhausted. So going forward, all of those legal expenses will be paid directly from the trust. Vicky, correct me if I'm wrong, but I think that's accurate.
You are correct.
Page 12, very quickly, Sherry. Investment fees and expenses are running well ahead of the same period, but significantly below 2022 levels. And while management fees have been stable across asset classes with minor fluctuations due to market values and allocation changes, the volatility we've seen has really been driven in the swings in performance-based fees. And that's consistent with the volatility we've seen in the markets and the corresponding performance impacts. The largest increase have occurred in specialty credit and private equity asset classes, while real estate has continued to see erosion of performance fees, kind of given the downward trend in real estate valuations. We've seen a sharp rise, as we noted last quarter, in the miscellaneous expense strategies, or miscellaneous expense category, excuse me. And that really is driven by strategies that rely on credit facilities. Obviously, given the significant sharp rise in front-end rates, those credit facilities that they use are more expensive than they were 18 months ago. And so we've seen a pretty significant increase in those expenses. No questions, we'll jump right in, excuse me, to the next section. Craig, do you want to make a quick comment, page 17? I think you wanted to direct everyone to the website if they wanted further information.
Yes, we produce weekly, monthly, quarterly, a whole host of webinars, as well as one-off topics. If you're interested in going into any of this stuff in more detail, either this quarter or in other quarters, since we usually give you a high level, go to wilshire.com, and there's a whole section of webinars and papers. And the quarterly deep dive is like an hour long, really deep dive into markets. A lot of the stuff we give you, a lot of focus on the Fed and what markets did, but also some more technical quantitative stuff that's interesting to some people. Usually not something we spend a lot of time on with big public pension plans such as yourself, but a whole host of information's there. And unless there's any questions, I would say the main fourth quarter update was that we saw a big a change in direction of rates after the really kind of seesawed from the third quarter to the fourth, and equities moved higher as rates were moving lower. And it was kind of a reversal of what we had seen the quarter before. That was the main theme. So as Chris alluded to, it was good news, and I'm sure Steve will hit on that here with your portfolio results.
Thank you. We can jump right to page 42, please. As Craig mentioned and Chris alluded to, I think it was certainly the last quarter, the second quarter of the fiscal year, last quarter of the calendar year was a bit of that, the old PIMCO Goldilocks, and the expectations that Fed was going to cut rapidly. I think at the beginning of January, we had priced in about 6 cuts for 2024. We'll talk a little bit later, but that's been dialed back some. And that Goldilocks period where we're going to have looser financial conditions, growth is going to be pretty steady, inflation is going to moderate. That really supports markets, and that was obviously across market asset classes in the second quarter of the fiscal year. For the quarter, the portfolios performed in line with expectations and really consistent with their benchmarks. The KRS pension composite produced a return of 5.81% for the quarter, with a KERS and SPRS portfolios returning 5.64 and 5.87 respectively, while their benchmarks returned 5.53. The KERS hazardous portfolio returned 6.45 versus its benchmark performance of 5.91%. Insurance portfolios had similar performance, with performance ranging from 6.30 to 6.50 and outperforming their benchmark, which returned 5.91%. Excuse me. Fiscal year to date, all of the pension portfolios have outperformed their respective benchmarks. So we were able to maintain that performance edge that was accumulated in the first quarter of the fiscal year. Preliminary January performance indicates that portfolios and benchmarks were relatively flat for the month, as performance was mixed across asset classes. Specifically, U.S. large cap equities and really large cap growth posted positive performance for the month, while U.S. small caps and non-U.S. equities struggled and posted negative performance. Core fixed income was modestly negative, as we saw rates inch up during the month. Real estate continued to struggle and was the worst performing asset class for the month. Specialty credit continued its rebound that we saw in the last quarter and was the best performing asset class for the portfolio for the month. February, markets have remained pretty soggy. Expectations, as I mentioned, have moved out to June from March for the Fed pivot and the starting of rate cuts. Fed officials have warned against the overexuberant expectations of policy easing, and economic data has continued to surprise to the upside. And that really, that's been the most recent turning point, was a very strong U.S. jobs report and higher CPI and PPI. At the same time, retail sales and housing starts have been weaker than expectations, which has caused that steady growth expectation to come into question, especially if financial conditions remain tighter for longer. Excuse me. I thought an interesting point to note was last week, Lawrence Summers actually said that there's a meaningful chance that the next move is up, as opposed to a cut, which roiled certainly equity markets. And we've seen that predominantly the best performing asset class or sector of equity markets has been large cap growth, tends to be viewed as the longest duration asset class or asset in the public equity markets. And those have taken the biggest hits, with the expectation that not only may we not get as many rate cuts as the market has anticipated, but they might come later. And if in fact a potential increase in rates is actually on the table, that would probably be very bad for equity markets.
Steve, I'm just going to interrupt for a second. Mr. Lane just joined us, and so we now have a quorum.
Okay.
Welcome, Mr. Lane.
Should we continue, or do you want to go back and you want to do the?
No, I think you finish yours and then we can go back and.
Okay. Page 56. I hope everyone, the new quarterly report.
We'll do that too. And then, yeah.
The last quarter was the first time we rolled out the new quarterly report format. I hope everyone I got some good feedback on it. I think it's a little more informative. I think that the formatting change is a little more intuitive to use and hopefully provided good information. So for the first 6 months of the new fiscal year, I wanted to highlight a number of investment highlights. The largest was really, across a number of legs over the first 6 months of the fiscal year, staff has been rebalancing the core fixed income portfolio. As you're aware, for a number of quarters, we had a tactical positioning that was short duration relative to the benchmark. So over a number of legs, we unwound that short, and that meant moving money from what was the Lord Abbett short duration credit portfolio into the two existing core portfolios managed by Nissa and Loomis, as well as funding an internally managed passive core fixed income portfolio. Additionally, we saw specialty credit managers continue to find compelling investment opportunities and deployed $150 million during the period, including the first capital calls for our new Adams Street fund and co-investment vehicle that were approved in 2023. We had almost $300 million called and invested by real return managers, and those were primarily the real return managers that the slate of 3 that were approved last year. And that included the initial investments for Arctos and Maritime Partners. Rebalancing activity in public equities totaled about $150 million as we continue to manage exposure across cap weights and geographies. A lot of that rebalancing is kind of as markets have been trending, and certain parts of the public equity markets have been outperforming significantly, as we saw in some of the graphs that Wilshire provided. That's necessitated us to dial back some of our rebalancing of the overweights that outperformance caused. I would also note that the first proxy reporting vote was posted to the KPPA website. It took a lot of work. Joe Gilbert did a great job working with our external managers. So as of the beginning of the fiscal year, all proxies are being voted in accordance with the KRS proxy voting policy, and the first report was posted to the website. Page 57, please. As noted in the investment highlights, the rebalancing in the core portfolio resulted in the termination of the Lord Abbett short duration credit portfolio mandate. Some detail in the memo that was provided here, including that there's one security that is still outstanding. The manager has not found or not liked the pricing they've received. They don't believe there's sufficient liquidity in the market for the one line item bond that they still hold across portfolios. And they will not be charging a management fee as they look to exit that position, or it's a short position, or until it matures. So terminating that mandate resulted in the reallocation, as I mentioned, amongst the two existing managers, as well as funding the internally managed account. The funding of the internal management account will save approximately $1.5 to $2 million in fees per year. And as you'll note on the next page, the Lord Abbett portfolio performed very well for the systems, both on a relative and an absolute basis. So it was certainly not a performance-related issue for Lord Abbett. It met or exceeded our expectations from a performance standpoint, delivering excess return relative to its benchmark. And then overall in the core fixed income portfolio, that positioning short duration, as we notice, as I highlighted here, over the last 3 years, produced about 381 basis points of outperformance relative to the benchmark, assuming that we had been at a benchmark duration. Additionally, as I noted on the quarterly far left bottom chart, if we hadn't rebalanced and we saw the decline in rates that we saw in that quarter, it would have resulted. So the difference between unrebalanced and rebalanced was about 160 basis points of positive performance for the core portfolio. So timing, it wasn't perfect, but it was pretty good. Again, we based that on our view when we initiated the position, and as that's evolved over time, where we thought a relative opportunity from a yield perspective, where yields were priced appropriately. We came off of the ZIRP world. Obviously, now we believe that core portfolio serves as a ballast against the other positions in the portfolio and the other allocations that we have. So we thought the opportune time from a rates perspective, as well as what an outlook for the economy was. I'll pause there if there's any questions. That's set quite a bit there. If not, we'll go to page 59, please, Sherry. As I mentioned, for the quarter, the largest contributors to outperformance were the underweight positioning in real return and real estate, with real estate being the worst performing asset class for the quarter, as well as the underweight in private equity. Excuse me. Outperformance in the private equity portfolio was a positive contributor. The most significant detractor of performance were overweights to specialty credit, which we used as the proxy for real return, as well as the overweight in cash, and a slight underperformance in the specialty credit portfolio. Really, the specialty credit portfolio, as we think about it, is two parts: that public high yield bonds and public loans. All of the mandates in that part of the portfolio outperform their respective benchmark and perform very well. The specialty credit overall underperformed, primarily due we have a number of mandates that invest in structured credit and mortgage-backed exposure, and those were a drag on overall performance as they failed to keep pace with the rally over the last 3 months. Outperformance in the real return allocation continues to be paced by our MLP exposure, which has returned over 12% fiscal year to date. As strong cash flows, disciplined CapEx, and consolidation have continued to benefit the industry. Page 71, please, Sherry. Briefly touch on this. Again, this is always one I like to highlight. One of my favorite graphs from Wilshire. From a broad peer perspective, all of the portfolios continue to perform well, especially on a risk-adjusted basis. As we see, they produce top decile Sharpe ratios across time. And I wanted to highlight the difference in, especially as we just went through the recent allocation work, page 71 and 72. If we compare those two, the difference in the graphs on this page highlight the differences between the allocation targets for the plans, especially with regard to risk. So we see we have much lower risk profile allocations and then slightly higher risk profile allocations. But the important takeaway to me is the consistency of the risk-adjusted performance that we've been able to deliver across those different allocation guidelines and targets. So even with a lower or higher risk target, which results in different allocations, consistently across those portfolios, we've been able to deliver very strong risk-adjusted performances evident in the Sharpe ratios across all portfolios. Page 83, please, Sherry. We sound like a little bit of a broken record, but staff has been working diligently to prudently rebalance the portfolio asset allocations to their IPS specified ranges and towards their respective targets. I did want to highlight from the beginning of the fiscal year to now. So at the beginning of the fiscal year, we had a total of 25 individual asset allocations that were not in compliance with their IPS specified allocation ranges. As of December 31st, that total of non-compliance allocations was down to 14. As we'll notice across these graphs as well, with the majority of those outside of range, less than 50 basis points outside of the range. So not only have we moved closer towards the range, but we've really narrowed down how far outside of compliance we are. I think that's pretty significant movement over the course of 6 months. I would also, as of today, with the new allocations, just 3 overall allocations are outside of the ranges, and we expect to have those in compliance, hopefully by the end of this quarter, if not the beginning of the next quarter, and certainly by the end of this fiscal year. As I like to highlight as well, for the quarter, I think it's important, the allocations that were outside of the specified ranges, so those all of the allocations that they're outside of the ranges that were specified in the IPS, what was the impact on performance? I think that's a good question to ask. And for this quarter, they had a modestly positive impact on overall performance. And that was really driven by that underweight in real estate. Again, the worst performing asset class for the quarter, and the overweight in specialty credit benefited performance, while the overweights to cash for some portfolios was a detractor to performance. So in total, they had a modestly positive impact on performance.
Steve, do you think getting a real estate back into compliance will be making allocations to existing managers or hiring new managers, or both?
Probably a combination of both. We have capacity with existing managers. I think that's under consideration right now, whether or not we add. It's an interesting time for real estate. We have benefited from an allocation perspective in having what I would say is a lower overall exposure to commercial real estate, which has been a benefit to performance. So we're looking at where the opportunities are right now, and whether or not the existing managers that we have are well positioned to take advantage of what we think is going to be an opportunity in the market, or whether or not we need to source a new manager. So if I had to say, it would probably be a combination of both. No other questions? We can go to page 99, please, Sherry. Thank you. We've continued to refine the compliance report. There were some changes between the last report and this report. And that's really in an effort to increase transparency, ensure that we're providing the IC and board members with all of the information they need to fulfill their governance responsibilities. So we're trying to do a little bit of a deep dive into all of the restrictions, as I've mentioned, both from an IPS, an individual guideline at the manager level, as well as where there are statutes that require compliance. So we continue to add to this. I think it's becoming more robust. I like the direction it's headed. I would note that starting on the bottom of page 101, we've highlighted the allocations that were not in compliance with the specified IPS allocation ranges for each portfolio as of the end of the quarter, as well as the magnitude of each respective non-compliance. Again, this is something that, we had a waiver and that's specified in the IPS, and language specified as to a time frame when allocation changes are made, how quickly we have to come into compliance with the new ranges and the targets. I felt that we had a long enough period of time, so I thought it warranted being highlighted on this report. As I mentioned, as of today, that number is down to 3, and we expect to be completely in compliance, hopefully by the end of this quarter, if not the very beginning of the next quarter. So I went through everything very, very quickly. If there's any questions, I'm happy to take those.
Steve, this is David. I don't have any questions, but I just sometimes I'm sure that it feels like you're doing all of these things with not much attention drawn to them. But first, I just want to commend you for the way in which you're putting these reports together and the commitment to transparency, the progress on allocations, and the compliance report is impressive. We still are in an incredibly volatile phase of the economy. That Goldilocks moment may be occurring right now, but it's a soft landing is only a moment in time, and what happens after that can't really be predicted. The political climate, the global climate, is certainly as disruptive as it's ever been, following on the heels of a pandemic. And so I think this has shown, particularly against benchmarks, that the general philosophy of a very diversified portfolio has served us well. But your stewardship and your team and the partners that we use gives me some reassurance that we're certainly headed in the right direction, and that progress shouldn't just be taken for granted. And so I would just commend you and your team and everyone there for taking the steps necessary to move us more into compliance, but also to report to us in a way that, for me, is easy to understand and very thoughtful. So I just wanted to give you that feedback.
Well, I appreciate it, and that's ultimately our goal. Obviously we partner with you guys. We appreciate all the support that the IC and the board has provided us. And I think that the patience, I can't overstate that. We really, you're exactly right. I've been doing this for a very long time, longer than I care to admit. And it's interesting because there's always volatility. Volatility is opportunity, but this is one of the more difficult. I mean, I think there's some really unique challenges to the current market, and the bifurcation and the potential impact. I mean, the tails on this seem a little fatter than we experience it in normal times, and I think that's really. I think we've taken a very prudent approach to deploying capital. We haven't rushed into commitments, and we support. Obviously the support of the IC and the board is important to us, but we support our managers in being prudent in deploying our capital as well. And I think that hopefully that plays out well with performance. It has. I mean, our performance holds up. And again, I highlight the risk-adjusted performance that we've been able to deliver, obviously with our managers, with our allocations, and with our positioning. I think that's something all of us should be proud of. I think that's it speaks well to the thoughtfulness that the investment committee especially puts forth when they consider allocations and changes to allocations. And I feel strongly that the portfolios are positioned well where we are, but we also have the capacity to take advantage of opportunities that the market might present. So, and staff, we have daily discussions. We have a great staff. This investment staff is, they do great work on an individual level, and collectively, I think we're pretty strong. So I put us up against a lot of different pension plans. We might be small, but we're mighty. So I appreciate that feedback. Thank you.
And I guess it should go without saying, but we always ought to say it. But some of the ability to have the capital necessary to leverage into some of these opportunities against a very disruptive economy are only possible because of the investments that the legislature has been willing to make.
Absolutely.
In shoring up our funds. So, investment returns are all relative to what kind of capital you have, and their commitment to help bolster the system is a testament both to the leadership of the KPPA staff, but in communicating with them and forging a partnership. But there's a whole lot of other priorities they could deploy public dollars to, and their investment in the future of retirees' financial security is all a part of this equation. So,
absolutely, and I think that that certainly is part of our job and our objective. As a system, as an entity, as a staff, is to continue to bolster that support and ensure that they have confidence that we're being good stewards of the investments.
Great. If no one has anything else, comments for Steve or questions, should we go back to the approval of the minutes?
Yeah, we just need Mr. Atkins and Mr. Lane to be on camera for voting.
And I would
Vicky,
move
am I-
approval. I would move approval of the minutes.
I'll second.
Any discussion? All in favor?
Aye.
Aye.
Opposed? The motion is adopted.
Did not Pruitt need to be on camera?
He did.
thought- Well, okay, I'm on.
Oh, there you are.
camera now.
You're on camera.
I don't know how to operate this thing. No, yes, my votes stand as verbally offered.
Thank you. So does that, then we can adjourn? Is that where we are, Victoria?
Yes.
Okay, perfect. There being no further business, this meeting is adjourned.
Thank you very much.
Thanks.